Hey guys, it's Matt Vanderzalm here with Coldwell Banker Momentum Real Estate Brokerage, and today we are going to be going over mortgage rates. I'm going to give a broad explanation of what mortgage rates are, how they affect you as a buyer, and then maybe a couple examples of how they're going to affect your loan payments over time. Let's go! So what are mortgage rates in real estate? This is just going to be a quick video explaining what mortgage rates are. I am not a mortgage expert, but I just want to give a high level overview of what they are to maybe someone who's never purchased a house before or doesn't really understand how the mortgage rate affects how much their home is going to cost. So essentially mortgage rates are the cost of borrowing money represented as a percentage of the total loan that you're going to take out. When you take a mortgage out to purchase a home, the lender, either the bank, financial institution, whoever's loaning you the money, charges you interest on the loan. The interest rate, which is the percentage, pretty much dictates how much extra you're going to pay on top of the principal amount that you borrowed. So the principal amount is the original borrowing amount. So a low mortgage rate, for example, we'll say 3%, means lower monthly payments, where higher interest rates is going to coincide with higher monthly payments. So the interest rate is set by the lender, but it is influenced by broader economic factors as well, such as Federal Reserve policies, inflation, and market conditions. In real estate, interest rates affect the demand for homes, affordability, and overall market activity. So to give an example of how mortgage rates affect loan payments, we're going to look at two different people, both purchasing a $500,000 house in Canada. We're going to assume that they're both taking out a 25-year fixed rate mortgage with a 20% down payment, so $100,000. The total amount they're going to be borrowing is $400,000 in this scenario, and we're going to compare what the payments are with a high interest loan versus a lower interest loan. So person one is going to be taking a loan out at 3.5% interest rate. You're going to be paying roughly $1,996 a month. $1,166 of that is going to be going toward the interest payment on the loan, and $829 of that is going to be going toward the principal. So over 1 year, they're paying just under $24,000 for their home. Just under $14,000 of that is going toward the interest on the payments. About $10,000 is going toward the principal, so equity they have into the house. So the total interest paid in 25 years is just under $200,000 for person A. Person B is going to be taking out the same loan at a 6.5% interest rate. Their monthly payments are going to be just shy of $2,700 a month, with $2,166 going toward the interest portion of the loan, and just $530 going toward the principal payment. So the payments for person B in the first year are going to be roughly $32,360 total, with $25,756 of those dollars going toward the interest on the loan, so money they're not going to get back, and only $6,595 going toward the principal payment. So over the full 25 years, if interest rates didn't change, person B is going to be paying over $400,000 in interest on the loan they have for their house. So when you break it down, it's pretty crazy to see the amount of interest that you're going to be paying just in general. And person B at the higher rate is paying over double the amount of the interest that person A is, $200,000 plus more, with just a 3% increase in interest rates. So there's just a couple key points I want to highlight with this example. Looking at person B, you can see their monthly payment's going to be much higher than person A's. And over the first year, they're not only going to have paid significantly more in interest than person A, they've also paid less toward their principal, which is the equity in their home. So the other thing I wanted to touch on is how mortgage rates affect qualification for a mortgage. So without going into too much detail and depth about it, essentially mortgage rates affect how much of a payment someone can afford each month. Lenders use this monthly payment to determine whether or not a borrower is going to be able to manage to make payments and still fit inside of their ratios that they have prescribed. Long story short is the higher the interest rate, the higher the monthly payment's going to be, and the less home you're going to be able to afford in the eyes of the lender. So for example, we're going to look at mortgage qualification using two different interest rates. Person A is going to have a 3.5% interest rate, while person B is going to have a 6.5% interest rate. For this example, we're going to be assuming that both people make $100,000 a year. We're going to be assuming this person has no other debts. Their property taxes are around $300 a month. Heating costs are about $100 a month, and they have a 20% down payment. So those are all their expenses. They're going to be looking at a 25-year fixed rate mortgage, and we're going to be using the bank stress test, which is the qualifying rate plus 2% or 5.5%, whatever's higher. So at 3.5%, person A will be approved with a total loan amount of $468,000. So they'll need a $117,000 down payment, while person B at 6.5% interest rate will be approved for a loan of $374,000, and they'll need a $93,500 down payment. So just looking at this example, person A is going to be given a loan roughly $90,000 more than person B, just based on the interest rates and everything else being the same. All right, guys, that concludes my video on mortgage rates and how they affect you as a buyer. Let me know what you guys think in the comments below. If there's any questions you have, feel free to hit me up on any of my contact methods listed in my bio. Let me know if there's any other videos you guys want to see. If you have any questions about real estate, I'm looking for content ideas. So yeah, hit me in the comments or send me a message too if there's anything you want to see with that. So thanks for watching, and as always, have a blessed day.